Hey guys, welcome to Big Trends Monthly. I'm Josh Brown and I'm here with JC Parets of All-Star Charts to break down the monthly closing candlestick charts. And we like to reveal the most meaningful market moves around the world using these particular charts. Candlestick charting originated in the 1700s as speculators in the rice markets of feudal Japan saw the advantage of visualizing the four most important prices of each day: opening, closing, high, and low. As each month comes to an end, every investable asset class produces a new candle on its monthly chart. These are the most notable monthly charts and the stories behind them. And you can subscribe to more research from JC Parets at allstarcharts.com, and we'll put links to that below. JC, it's your show. What do you got for us this month?
My show.
Well, for the time being.
I've always wanted my own show.
Well,
who invited you? All right, so listen. So before we get into the candlesticks, you can't just dive into the candlesticks. Like, you're not just gonna go have your Wagyu beef. Like, you gotta like ease into it. Maybe have like a little salad, maybe a little like sashimi. Kind of like work your way into them.
I like to start with like a gyoza, like a pork dumpling, and then get into it.
There you go. Yeah, pork dumpling. There you go. All right, so this is our pork dumpling. This answers the question, in my opinion. Do we want to be spending more time looking for stocks to buy, or should we be spending our time looking for stocks to sell? Financial advisors love this because it helps with, asset allocation. Should we be overweight bonds, right? Should we be more overweight fixed income versus stocks? So I just think comparing the NASDAQ to US Treasury bonds just serves so many purposes. But for our purposes today, I think it just reiterates that if we are above all of these highs since 2018 in the NASDAQ relative to bonds, I think that answers the question: should we be dedicating our days looking for stocks to buy or looking for stocks to sell? I think this suggests we should be looking for stocks to buy.
So this is a ratio chart. You're doing the Triple Qs, which is the NASDAQ 100 ETF, divided by the long bond. TLT is 20 plus year Treasury. And what you're basically doing here is, with this ratio chart, you're looking at one trend versus another, or one trend priced at another.
That's right. So to me, I think if you're one of these gloom and doomers and you think the world's coming to an end, or you don't like the president or the Fed or Spanish debt or whatever it is you're into, I think that this is the chart you need to watch, because you're only right on the end of the world if this ratio is back below those 2018 and 2020 highs. We have to be back below that for there to be trouble. And that's just not the case. Former resistance is turning into support, which is, as you're well aware, they teach you this stuff in the second day of technical analysis kindergarten.
We had an opportunity early in September with big, large cap technology breaking down hard, and a lot of strength in treasuries. There was an opportunity to break below, but we bounced exactly where you would have expected if people want to keep the party going. Let's get into these bubbles. So you're showing leadership from consumer discretionary, which I don't know if a lot of people realize how important this sector has become in an economy where 70% of GDP is consumer spending, and Amazon is actually listed as a consumer discretionary stock. And Amazon basically is the economy, at least online. So it's a very important group.
Yep, and we mentioned last month, remember, that consumer discretionaries made all-time highs relative to consumer staples. They did again this month, FYI. So discretionaries, once again, all-time relative highs relative to staples. But this is a really important chart, and you make an interesting point with Amazon. So there's two things going on here. On the x-axis, that's the one on the bottom, we're looking at the percentage gain off the March low for the market. So in other words, the further to the right it is on the chart, the better it's done since the March lows.
Hold on. What is in this mid-cap discretionary up 124%? Is that like Lululemon? What?
Anything any discretionary stock between 2 and 10 billion is in the mid cap. So you could punch that up. Also, the small cap discretionary up 116%. Also, the equally weighted discretionary, that RCD. So that eliminates the Amazon effect from consumer discretionary, because Amazon represents such a large percentage of that index that we want to equally weight it and kind of add that to the bunch. So small cap discretionary, mid cap discretionary, large cap discretionary, cap weighted discretionary, equally weighted discretionary. These are the best performers, not just off the March lows, but also in the third quarter. So on the y-axis, up and down, the further it is to the further up it is, the better it did in the third quarter. So in other words, everything to the upper right is the best. But notice that it might not be the best off the March lows, but right in the middle of the chart there, you've got industrials, you've got equally weighted materials, you've got equally weighted industrials that maybe they haven't done as well as discretionary since the March lows, but they certainly did as well as discretionaries in the third quarter, right? So that's a very interesting rotation.
What's going on in industrials is fascinating right now. When you equally weight it, what ends up happening is that housing stocks become much more important. The home builders are up like 80% over the last 6 months. The industrials are up about 30% in the same period of time. But the home builders are not big stocks. They're mid caps, like almost by definition. But when you equally weight it, there are a lot of them, and they become much more important in the equation than they'd normally be.
Josh, my buddy Todd Sohn, who you know, the way he puts it is that he's like, and I agree, industrials are such a diverse sector. You've got railroads and you've got this delivery company. I mean, there's all sorts of stuff going on.
Defense contractors, like everything under the sun.
So equally weighting industrials and comparing it to, let's say, an equally weighted S&P, I think makes a lot of sense to really get a good idea of what's happening in that space. But you're stealing my thunder with the home builders. You want to move to the next chart?
Let's do that.
Here we're looking at that home construction right there, baby. All-time highs. These are the highest levels ever. Right?
Above the housing bubble.
Yep, above the housing bubble, which the funniest part is that the geniuses over at iShares and over at Standard & Poor's created the ETFs, ITB and XHB, like the month that they peaked, and they went straight down from there.
That happens more than you'd think, or maybe not more than you'd think, but more than most people think.
Right.
Yeah.
So here they're making all-time highs above those highs, to your point, above the real estate bubble peak. And then also equally weighted retail also pushing up against all-time highs. Equally weighted, Josh.
Yeah, so we're days away, I think, from a compromise between Congress and the White House, really Mnuchin and Pelosi, on the next stimulus, which probably is coming 2 months later than it should have. But I have a sense that a lot of the strength in things like equally weighted retailers, your consumer discretionary chart from the prior slide, I have a sense that some of these things can continue to outperform and continue to break out. Once that happens, we've just had this tremendous tailwind in consumer spending, unlike we've had in any other recession. So I think there's a lot going on there. Why are you showing us these two charts on the same? Is there something about the way they're both acting that's notable?
Well, two things. You only let me bring so many charts, so I guess it's not my show after all. So this allows me to put 2 in 1. You know how I roll. And then it also is basically it's continuing that story of consumer discretionary, right? These are both in the consumer discretionary space. So we're talking about just ridiculous outperformance out of discretionary, not just off the March lows, but throughout the third quarter. Well, here are those sub-industry groups that I think we need to focus on: retail and home construction, pushing up against new highs, not evidence of a downtrend.
And almost nobody talks about these stocks because they're not cloud computing, they're not working on a vaccine. They're not, D.R. Horton is not working on a vaccine, right? But they're just
we'll get to the software. I couldn't not have a conversation without talking software. So we'll get there.
All right, skipping ahead to emerging markets versus S&P 500, another ratio chart. What's happening here?
Well, as soon as emerging markets, they launched the ETF in 2003, the outperformance just rip-roar from there. And it's been a disaster since 2011, right? Yep. Emerging markets have just not been able to keep up with the United States. We can argue that it's maybe because they don't have technology or the consumer, like you mentioned. Who knows what it is? It doesn't really matter. Tremendous underperformance out of these emerging markets. Now, there's two things happening. Now there's a lot more tech in things like China, where you have Baba and Tencent and things like that. So now you're actually getting more tech exposure in emerging markets, less natural resources than you once did. Maybe that's the catalyst, maybe not. I'll leave that up to you guys. I'm just pointing out that Where are emerging markets finding some sort of outperformance? Exactly where they started getting that outperformance 17 years ago. Well, I don't necessarily think that that's a coincidence. And then look at that box. That box shows the performance of the S&P 500 in September, right through the weekend, right, not including yesterday. And then frontier markets going sideways during that period. Let me remind you what's in the frontier markets. These are countries that aren't, they're not good enough to be in emerging. Kuwait, Kazakhstan, Nigeria, not exactly where money goes to hide when, you know, the world's falling apart, right? These aren't exactly safe havens. Like the Bank of Kazakhstan is not exactly, you know, an area where you're going to go hide as money comes out of Well, apparently they are. So my point is, we're seeing relative strength while tech is rotating, while the U.S. is going under, you know, a slight correction. Frontier markets are hanging in there stronger than ever. At the same time that it would, at the same location that it would be a logical place for emerging markets to start to outperform. So this is kind of like if micro caps are doing well, small caps are probably doing well too. This is kind of like that. If frontier markets are doing well, how bad could emerging markets be?
Yeah, so the EM thing is so interesting. Like that mid-2000s period where everyone fell in love with EM, it was really what they called the brick trade. Brazil, Russia, India, China. China was small in the index. Actually, they had Hong Kong stocks. Oh, they had some Chinese stocks, but compared to the size of that market now, it's nowhere near as much representation. And China's like got one of the only sovereign bonds that has any yield. I think their bond, their 10-year is like 3%. Demand for Chinese currency is strong because they're exporting like crazy. Their economy has done much better than ours has, and they had a much less harsh fight with the virus. So when you have bigger exports out of China, that fuels demand for more yuan. So their currency is strong, their yields are higher than almost anywhere else in the world, and their economy is recovering faster. And when you put all those things together and then combine them with the fact that it's one of the only countries that has a huge tech sector like we do, makes a lot of sense to see EM find some support here. And then it's not just China. Like South Korea, first of all, they banned short selling during the crisis.
Somewhat American.
Yeah, there's a journal article about how like I guess the hedge funds in South Korea, they're like, can we short stocks again? And the government's like, nah, we're gonna keep this the way it is for a little while.
Well, in a lot of countries you can't short stocks, right? Because Soros one time it was bigger than the entire Malaysian market. So he tried to like short it to zero. So they're like, no more shorts.
Dude, the guy that's like, I think he works for one of the big brokerage firms in South Korea, who's like a critic of that policy. And he's like, I want to be able to short stocks. He's getting death threats, he said, and he bought a stab-proof jacket for his morning commute. Like this is what's going on there. All right, let's not get off on a tangent. IPO ETF. So I was talking about this the other day. Like, how bearish can you be when the IPO ETF is making new record highs? Like, isn't that such an important signal about investor appetite for risk? I'm not saying it's good or it's bad. It just is what it is.
When you hear that 5 stocks control the market, they do in a market cap weighted index. So while some of the biggest names might be consolidating and some of the smaller cap names are absolutely ripping, like the names on the IPO list, that their market caps are, you know, minuscule compared to these giants that, you know, are huge components of the S&P. So if you're only focused on the S&P, you're like, oh yeah, the market can't go anywhere because of these 5 stocks. Okay, well, why don't you not focus so much on the indexes and focus more on the components themselves? And you're going to find a lot of opportunities, which really presents a bigger story. When you go through all the indexes, which, as you know, I do quite often, there's just a lot of messes. Like look at Germany, you know, go around the world, not just in the S&P 500, transports, like just big sideways ranges. So what does that mean? I think that means we focus less on the indexes themselves and more on individual components. And I realize that's harder for financial advisors to do. I understand that. But just that's not my fault. That's just the environment that we're in, right? And in this particular environment, I think it's important to pay extra attention on the components themselves when the indexes, not just in the US, but globally, are kind of messy.
Yeah, the holdings in this ETF. This is Renaissance Capital's.
Yeah.
I'm not criticizing because I don't know how else you would do this. But a lot of people would look at these top holdings that you're showing and say, like, how are these IPOs? Some of these companies went public in 2019. The way they construct the index is that they'll hold the stock for a period of time and then it drops out because it's been public for too long to still be considered a recent IPO. But some of these, like Uber is a $60 billion market cap. Zoom is over $100 billion.
It is now.
Right. It's like some of these are like, wait, really? That's an IPO? I feel like I've been trading that for 10 years. So I think they hold them for a year or 18 months or something like that.
D-Dog just broke out this week. That's another big one. So
I listened to the Datadog conference call. The founder and CEO, he's got like this amazing Parisian accent. He's such a kick-ass guy though, explaining like why their business is doing so well in the pandemic. It's really great story. What's PCTY?
So not Party City.
It used to be though, right? Did it used to be?
I don't know. Somebody brought it up the other day. They're like, JC, I ignored it completely because I thought it was Party City. No, it's Paylocity.
Oh, Party City is a stock that you and I would have blown ourselves up in like 15 years ago, for sure.
Well, people think that this is that. It's not. Okay. This is a stock that's breaking out to all-time highs, which we love. And this is part of our 2 to 100 club. These are stocks that are graduating from small cap to mid cap. In this case, soon to be graduating to large cap at 10 billion plus. I think it's got another 80 points of upside. This is an uptrend. I like to show sort of examples of, I'm talking about focusing on individual securities and less on the indexes themselves. Boom, here's an individual security. I can give you a bunch more. We talked about Datadog breaking out, but let's just focus on Paylocity here, PCTY. I like it. If we're above last year's highs, what's there not to like?
What are you doing with the arrows here? These are Fibonacci retracement levels?
Yeah, these are extension levels. These are levels where, we calculate old highs. They serve as support or resistance levels. I don't want to go off on this tangent, but at the end of the day, the market respects these levels for whatever the reason, so we do as well.
Are there a lot of charts that look like this right now?
That are going from the lower left to the upper right? Yes, well, there are a lot.
But I'm saying stocks that broke above last year's highs and then just kept going and stayed that way. You finding a lot of them?
The big high, Josh, is the 2018 highs. Whether you're looking at maybe Q1 of 2018 or summer 2018, depending on what we're looking at, those are the big highs. Last month we talked about China breaking out above those highs. I would encourage anybody who's anchoring to specific dates, focus less so on the year-to-date highs and focus more on whether what you're looking at is above the 2018 highs. Like if you're going to anchor to anything, I think it's that.
Those 2018 highs are so notable because it was actually a double top for the broad market. You hit a high in the first week of February, the trade war starts, they destroy the market, then you recover all year, and then inexplicably in September, probably something to do with the Fed or whatever at the time, but you double top at that level, sell back off viciously, a 20% bear market in the fourth quarter. It's very rare. And then when the market finishes flat, but it's very rare to have a double top that pronounced inside of one calendar year. Is that why that's so noteworthy to you?
Well, that's when stocks stopped going up in January of 2018, right? So what you're referring to is the US stock market, which did double top.
Yes.
Most of the markets around the world did not, right? They just kept going straight down. So It was really that relative strength in the US that you're talking about. It was really just risk. Global risk peaked in January of 2018.
Yeah. And then until now.
Right.
All right. So we're going to send people to allstarcharts.com. We're dropping links. And you're doing this, what do you call it? 2 to 100?
2 to 100 club.
All right. So where can people find that? Because I bet there's a lot of people that are interested in learning more about that.
Yeah, here's what we'll do. Go to email candles@allstarcharts.com and just put the password 2 to 100. And what we'll do is we'll send you the latest 2 to 100 report. which gives you our universe of stocks that runs through a series of filters, and we'll go over those. Those are listed, and then we go over some of the trades that we like best in that index.
All right, dude, you're a beast. We will see you the first week of November when we have the next monthly candlesticks. And until then, arigato.
All right. Buy in October and get yourself sober.
All right.